Chapter 12, Section 1, Take 1, Professor Rennell Brown, in 5, 4,
At the conclusion of Chapter 12, you will have a full understanding of long-term liabilities and how to complete an amortization table as well as journalize the payment entries. An installment note is a debt that requires the borrower to make equal periodic payments to the lender for the term of the note. The annual payments include a portion of the amount initially borrowed, which is called principal. It also includes a portion of interest that is calculated on the remaining outstanding balance. At the end of the note, the principal will have been repaid in full. Installment notes are often used to purchase specific assets such as equipment and are often secured by the purchased asset. When a note is secured by an asset, it is called a mortgage note. If the borrower fails to pay a mortgage note, the lender has the right to take possession of the pledged asset and sell it to pay off the debt. Let's review an example. Assume that Lewis Company issues an installment note to City National Bank on January 1st, 2015. The principal amount is $24,000, the interest rate is 6%, the term of the note is 5 years, the annual payments are $5,698. When an installment note is issued, an entry is recorded debiting cash and crediting notes payable. Therefore, the entry to record the issuance of this note is a debit to cash for $24,000 and a credit to notes payable for $24,000. This records the receipt of the loan and the amount of the note that is now due to the bank. The notes payable requires Lewis Company to repay the principal and interest in equal payments of $5,698 beginning on December 31st, 2015 for the next 5 years. The installment note payment of $5,698 includes interest and principal. This exhibit shows the amortization schedule for this note. Let's review the schedule and walk through the steps of calculating the annual payments. The first column lists each year of the loan. Column A is the carrying amount of the note at the start of each year. Column B is the annual payment amount. Column C is the interest expense portion of the annual payment. Column D is the principal portion of the payment. Column E is the carrying amount on the note after the payment is made. The first year of this note is 2015, and that is the first year entered in the year column. For 2015, the January 1st carrying amount is the total amount of the loan, so $24,000 is entered in column A. For column B, the annual payment is given in the problem, and it will always be $5,698 every year. In column C, we need to calculate the interest portion of the payment amount. This is done by taking the carrying amount in column A, which is $24,000, and multiplying it by the interest rate of 6%. The interest amount that should be entered in column C for year 1 is $1,440. The next step is to calculate column D, which is the portion of the annual payment that is principal and will reduce the amount of the note. This calculation is made by taking the payment amount of $5,698 and subtracting the interest of $1,440. The answer is $4,258. This is the amount of principal. The last step is to calculate the carrying amount on December 31st after the year 1 payment is made. This is done by taking column A, which is the carrying amount at the beginning of the year, and subtracting column D, which is the principal portion of the payment. For year 1, we need to subtract $4,258 from $24,000, which is in column A. Let's walk through year 2, 2016. For year 2, the carrying amount as of January 1st will be the ending balance for year 1 in column E. For year 2, we need to enter $19,742 for the January 1st carrying amount. Column B is the payment amount of $5,698, It remains the same for the life of the note. To calculate column C, which is the interest for year 2, we need to multiply the interest rate of 6% by the year 2 carrying balance, which is $19,742, and is listed in column A. The interest amount for year 2 is $1,185 and is entered in column C. To calculate column D, we need to take the amount of the payment, which is in column B, and is $5,698, and subtract the year 2 interest of $1,185. The answer is $4,513, and this amount is entered in column D for year 2. The last step is to calculate the carrying amount for year 2 as of December 31st and after the year 2 payment has been made. This is done by taking the carrying amount in column A for year 2, which is $19,742, and subtracting the year 2 principal portion entered in column D, which is $4,513. If the calculation is done correctly, the carrying amount entered in column E for year 2 is $15,229. The process above will be followed for the remaining years. If everything is calculated correctly, the ending balance in column E should be 0. The ending balance in column D should total back to the amount of the loan because column D reflects the principal payments made each year. The exhibits here reflect the journal entries required to record annual payments for 2015, 2016, and 2017. The payment amounts can be pulled directly from the amortization table. For example, the 2015 payment will be a debit to interest expense of $1,440. This total can be found in column C for year 1. The entry also includes a debit to notes payable in the amount of $4,258. This total is pulled from column D, year 1. The account to be credited is the cash account for the amount of $4,698. The payment amount is found in column A.
Keep rolling. Let's read the account to be credited. You said 4,000 and it's 5,000.
Oh, I did, okay.
So pick up in 5, 4.
The account to be credited is the cash account for the amount of $5,698. This payment amount is found in column A.